So I appreciate the opportunity to provide some remarks on the global energy agenda and give you a perspective on achieving increasingly urgent energy, climate, and sustainable development goals from the International Energy Forum, the IEF. As we meet this week, the interconnectivity of these goals are on full display. Gas markets in Europe and now Asia are on red alert. Natural gas is now the most expensive fossil fuel on an energy equivalent basis, comparable to an oil price of about $200 per barrel. It's critical that we don't let a climate crisis turn into an energy crisis. We need to keep making progress on climate action, certainly, while at the same time ensure that we have energy supplies today to power the global economy. And I'm particularly concerned about high energy prices and volatility and what that might do to undermine public support for climate action. Because once we lose public support, it's very difficult to build back. As a result, the IEF is announcing today that we will hold a special natural gas market dialogue meeting with both producer and consumer ministers on October 28th, along with industry experts, many CEOs of energy companies, both gas companies and power companies. So let me just go into a little bit of how we see the current state of the global energy sector, and especially with regards to the pandemic. Certainly the rebound in fossil fuel demand after the pandemic was really anticipated. As the world awakens after COVID, economic growth has returned. The OECD September report showed that global GDP is already above 2019 levels. The OECD global growth forecast for 2021 is 5.7%. In 2022, it's forecast to be 4.5%, and that's compared to a decline of 3.4% in 2020. In addition, something that we're all familiar with, the ongoing tightness in supply chains is also causing tension in the global energy market. And it also must be noted that government stimulus plans and programs support demand in infrastructure and construction and also generate more demand. The transportation sector was probably the hardest hit. Aviation is still about 25% below pre-COVID levels. It was offset, however, by increased demand in other sectors, for example, petrochemicals, industrial and power generation. And of course, we've had fuel switching mainly in Asia. As far as oil is concerned, really all previous oil demand shocks have shown strong and immediate rebounds, and this is certainly the case this time. So will 2021 be a record in fossil fuel demand? Well, it will be close. On a quarterly basis, the fourth quarter of 2021 will certainly be higher than 2019. Also, we had a warmer winter last year. In particular, Europe had a mild winter in 2019-2020. It was the warmest on record. And Asia had a mild start to the winter last year. So if this is just a normal or even colder than normal winter, energy demand will certainly be higher in the fourth quarter versus 2019. And unfortunately, this is very ominous for gas markets and the power sector. Last week, the IEA came out with their World Energy Outlook report, and it had two main takeaways, at least from our view. Number one, the world is not investing enough in clean energy to meet our climate goals. And number two, the world is not investing enough in oil and gas to keep up with our demand for fossil fuels. And the IEF agrees on both of these points. We must continue with the deployment of more renewables to meet our climate goals. But on the second point, I'd like to sort of talk a little bit more and give you a perspective from the IEF viewpoint regarding investment in oil and gas supplies. Last year, the IEF rang the alarm bell with a report that we issued along with Boston Consulting Group, Yvonne's former place of business, and we called it a peak investment crisis in oil and gas development. And essentially what we did was outlined CapEx cuts by companies of 35% in 2020. We're currently working on updating the report for a December release, and we're seeing another decline in CapEx investment this year of about 25%. We said at the time, 2 years in a row of significant CapEx cuts will result in volatility and higher prices, and it has arrived even sooner than anticipated. The report stated that industry investment will have to rise over the next 3 years by 25% yearly from 2020 levels just to stave off a crisis. So I also agree with others that say that there are many factors for the current gas crisis in Europe and that we can't blame it solely on the energy transition. Certainly COVID is a big reason, as I've explained, but as I've explained, there are structural and fundamental issues about energy markets and systems impacted by investment that are really at the heart of the problem. I'm very concerned about the upcoming winter months, but it's important to note that when winter is ended in April or May, whenever it will be, these structural issues will remain. Now, market uncertainty about COVID and the transition pathways present major challenges for policymakers and companies with regard to these investment decisions. The IEF every year in February hosts the annual Energy Outlook Symposium, and this is when we have OPEC and IEA come, along with many private sector companies, present their outlooks for energy for the upcoming year. And just to take a snapshot of these outlook scenarios, over the next 20 years, the difference between the high and low demand cases is about 55 million barrels a day, whereas 10 years ago, it was only about 30 million barrels a day. Just to put this in context, 55 million barrels a day is more than half of today's oil market. If you're an energy company, how do you run your strategy and plan your investments? And it's particularly hard for policymakers as well, as we're seeing played out. The world has clear goals, but it lacks clear policies and certainty. Finally, the other area of great need of investment, in our view, is clean energy R&D. The IEA technology report, which came out last year, is probably one of the best IEA products that has come out in a while. And that report said that half of the emissions reduction needed to meet climate goals must come from innovation and new technologies. As a U.S. citizen and the first Secretary General who is an American, I was pleased to see and have commended the Biden administration for proposing a four-fold increase in clean energy R&D to get to $30 billion by 2030. In addition, President Macron last week introduced a new modern industrial strategy for France to invest in green hydrogen and small modular nuclear reactors with an investment of $30 billion by 2030. I know Spain has made big announcements about green hydrogen, as has Saudi Arabia and the UAE, both of which hope to become major exporters of this clean energy. While the private sector is doing its part on R&D, we really need governments to step up and take primary responsibility for clean energy R&D. It's critical to meeting our climate goals. The IEF is encouraging all governments to take the lead in this regard, and we are currently working on a tracker of clean energy R&D by governments to monitor progress.